SaaS Backwards is sponsored by Austin Lawrence Group, specializing in demand gen for SaaS. It sure is noisy. I deleted 100 emails from vendors just this morning. Your buyer has gotten better at ignoring you, and you're gonna need a big idea if you want to cut through all that clutter. Austin Lawrence is just the right agency to help you find it. So if your campaigns are falling on deaf eyeballs, let's talk. Visit austinlawrence.com today and let's build something bigger.
Welcome to the SaaS Backwards podcast, where we reverse engineer the success of fast-growing SaaS firms and explore strategies CMOs and CEOs are using to drive their businesses forward.
Welcome to SaaS Backwards, a podcast that helps SaaS CEOs and CMOs to accelerate growth and enhance profitability. Our guest today is Marty Magida, Managing Director at Berkery Noyes, an investment banking firm that specializes in mergers and acquisitions, debt and equity financing, and financial consulting. We're going to talk today with Marty about preparing for an exit. But before we do, Marty, please tell our listeners a little bit more about yourself and your firm.
Thank you, Ken. Delighted to be here. And I'm Marty Magida. I'm an investment banker. I've been in the industry for longer than I care to admit. Started my career at Drexel Burnham. Spent a lot of my time doing IPOs, and the last maybe 20 years or so been focusing on working with private companies for capital raising and mostly M&A. In particular, I focus on technology, a bit of healthcare. The firm I work for, Berkery Noyes, is a 40-year-old boutique investment bank in Midtown Manhattan. We basically focus as well on technology and healthcare. We kind of sit at what's called the lower end of the middle market, which means our clients are typically being sold for less than maybe 250 or 300 million enterprise value. And we go down as low as a $20 million deal. So, a lot of people sort of figure the middle market kind of gets up to about $1 billion. In terms of enterprise value, we sit at the lower end of that. That said, we have done billion-dollar deals in our 40-year history, but that's not our mainstay.
I think plenty of our listeners would be very happy with a 9-figure exit. So I think there'll be a lot of interest in what you have to say. So our topic today is really preparing for an exit. But maybe before we dig deep into what a firm should do within itself, you could give us sort of the landscape here at the end of 2023. What do you see?
Sure. Yeah, happy to. I thought I'd spend a couple of minutes just chatting about the state of play right now in terms of M&A broadly speaking, as well as for technology companies. The good news is it looks like we've avoided a recession. It doesn't appear like a recession is on the horizon, but it is very much a difficult financing environment. I would imagine that your client base and your audience here is experiencing that. And while the uncertainty around the pandemic has dissipated and earnings are still pretty robust for a lot of companies and the employment picture is pretty good, it's really tough to raise capital right now. And what we're seeing is a lot of companies that were VC backed or bootstrapped, they're reaching the end of the runway. And we're seeing more activity, more companies now start to come to market. Interest rates are, while they're not going up like they were earlier in the year, they're staying level and they're still relatively high compared to the past few years. Now, for those of us who've been around a while, they're still relatively low compared to maybe a decade or two or three ago. Historically, the rates that we're experiencing right now are really not that bad, but they are certainly higher than they've been in the last, let's say, 5 or 6 years. And so there's basically two types of buyers, right? There's private equity / growth equity firms, and then there's strategic buyers or corporate buyers. The strategic buyers are in the game, but they're really cautious, and they're keen to grow via acquisitions, but they're really averse to diluting their earnings, and they don't want to pick up a big cash-burning company. If you're somewhere around cash neutral, they would have a bit more interest. But the appetite for, picking up a technology company that's burning through 30, 40 million is not there anymore. Private equity's got about $1.5 trillion to invest, but they're also going slow. So while there's a lot of cash, it's sitting on the sidelines, and the risk appetite is really diminished. Deals are taking longer to close. Buyers are increasing their due diligence, and there's no FOMO anymore like we saw in 2021. And then lastly, I would say we're seeing an increase in what's called structured deals to bridge the valuation gap between sellers and buyers. We're seeing more what's called earnouts or seller paper, where if you're a seller, you're not necessarily getting cash on the barrelhead up front. You may get a good headline number from a buyer, but they're going to pace it over time against milestones that you need to hit, or they're going to ask you to provide some of the financing yourself. So I just want to spend a little bit of time just talking about some metrics, some deal metrics, M&A activity in the most recent quarter. And what we're seeing is that deal counts, and I'm speaking in terms of North America, deal counts are down about 6% in the most recent quarter, but the deal values are down 25%. So what that means is buyers are turning to smaller deals in the face of the higher financing costs that they have. It's really hard to borrow money right now, and there's a continued valuation gap between buyers and sellers. So, deal value is down a lot. Now, within technology in particular, deal counts have held somewhat steady. They're somewhat flat. They're certainly down compared to a year ago or 2 years ago, but the last few quarters, they've been holding steady. But the deal values are really cratered. They're down like 33% or so.
Is the value or valuation or both that are going down?
It's valuations, so there's a couple of ways. Valuations are certainly lower, and because there is a heightened sensitivity to risk, the buyers are just doing smaller deals in particular. So here's an example. Private equity, they typically do two types of acquisitions. One is called a platform, and the other is a tuck-in. So a platform is like a foundational acquisition, that it's going to be independent, it's going to stand alone in the private equity portfolio, and they're going to grow it over time, at least theoretically. A tuck-in is an acquisition that is made by a platform company. So if a private equity firm owns a platform company, they'll do smaller deals that are called tuck-ins. And that's where we're seeing a lot of activity there. I'm looking at the numbers for the most recent quarter. Like 73 or 75% of private equity deals these days are tuck-ins. It's going up. And so these tuck-ins are smaller deals, right? So that explains a lot of the reason why we're seeing deal values go down, because they're looking at smaller companies. That said, strategics still account for 2/3 of all deals, strategic buyers. So, but they're still cautious as well, right? They're not doing, we saw, I think the only big deal we saw recently was Splunk got acquired by Cisco recently, but we're not seeing these mega billion-dollar headline type deals. The last thing I'll touch on as it relates to just kind of data is everybody's favorite topic, which is valuations. So if we just look at the trailing 12 months, and this is data from something called PitchBook that a lot of folks use, they gather a lot of data on acquisitions. If we look at the last 12 months, looking at all deals, valuations are this is mega deals. So these are deals that are $5 billion or larger. They can go for 4 times revenue. Now, if we look at deals that are below 100 million, okay, now we're talking about much, much smaller deals. They're going for 1.1 times revenue. So there's a massive dichotomy between the valuations that are achieved by big companies, the headline making deals that you read about, and the vast majority of deals that are out there. There's a premium given to the big companies. They're less risky. Whereas a small company, especially if they're not yet profitable, if they hit a speed bump, they could really be bleeding cash. And for that reason, they get a multiple that's like 1/4 what the big guys get. If we look exclusively at technology deals, what I just talked about was, all industries. If we look at technology deals, the good news is the multiples are higher. Multiples are about 2.7 times revenue and about 12.5 times EBITDA, if they have EBITDA. So that's where technology multiples are, at least for the past 12 months or so. I'll stop there and see if you have any questions.
Well, yeah, I think that, the SaaS valuations, especially for the sort of 20 to 100 million in revenue companies, a few years ago, they were much richer valuations, right? So founder looking to make an exit today is looking at a very different proposition than they might have looked at just before the pandemic, for example.
No doubt. It was not unusual to get a double-digit multiple on revenue for SaaS companies. And these days, that's a stretch. It happens. I mean, you're still seeing it, well, certainly within AI. In certain areas within cybersecurity, you're still seeing double-digit multiples. But in order to get that, you really need to be growing like 200-300% a year. If you're a 25% grower, odds are you're looking at a multiple that's, certainly in the single digits.
Cool. Well, I appreciate that level set. And I think that's a great segue into our next topic, which is if you're in that under $100 million range, which I think is most of our listeners are going to be, what are the ways they can approach maximizing value at sale?
Sure. Well, we'll cover a couple of ways to do that. The first would be to manage your risk profile, managing risk. And so what does that mean? Reduce any kind of concentration that you have, revenue concentration, customer concentration, maybe product concentration. Also, strive to be asset light. Now, for software companies, it's almost intrinsic that it certainly happens. But there are companies that have perhaps a hardware component. I can give you an example. We have a client that provides software that relates to special ed, okay? And it's software it's a teaching tool for autistic children. And they actually have a piece of hardware. So it's basically like a robot. And then there's software. And the software component investors are interested in. These are multi-year contracts. The hardware they hate, right? Because there's inventory and it's made in China, et cetera. So this company is now transitioning out of the hardware, and they're going to have avatars that replicate the robot. So the whole purpose of that is to be as asset light as possible and not have to worry about supply and manufacturing and all of that. So that's a good way to reduce your risk. And you want to look at all the risks within your business and identify it, be aware of it, and emphasize mitigants to that. A second way to maximize value is to improve the consistency of results. So SaaS, everybody loves recurring revenue. That's exactly what you're doing there. You're improving the consistency of the results. So you want to build an annuity, you want to have subscribers or members. To the extent you can get multi-year contracts, you'll get a better valuation for that. You also want to try to make it costly for customers to switch. So to the extent you can provide greater visibility and greater predictability of your results, you will enjoy a better valuation. Another example I'll give there. We had a client, software company. This was software that was embedded in large format printers. Okay, these are industrial type printers, not the type that you and I have on our desk, wide format. And a company that's been around a long time, they had 300,000 customers globally, a lot of them over in Asia. There's a lot of print shops over there and in India. So a good, strong installed base. The majority of their revenue was from international clients, but the software licenses were perpetual. And they were trying to transition this user base to SaaS. So at the time, of the 300,000 customers, they had about 14,000 subscribers. And they were doing about 4 million of EBITDA between the legacy model and the SaaS model. But they had a lot of trouble getting that number to increase. And particularly, there was an aversion. Now, this is going back a couple of years ago. This phenomenon may be less today, but there was an aversion among foreign clients to SaaS. It was sort of a U.S. and American phenomenon, and the notion, especially in Asia, of having to subscribe to software was anathema for a lot of folks. But the company was really going after that, and they had structural impediments to really kickstarting the SaaS business. So what they did is they made the price very, very attractive. And they also changed. Another impediment they had was they didn't have the ability to collect payments using local currencies or local credit cards, which is almost essential, right, if you're going to be charging monthly. So they addressed those shortcomings. They doubled the number of subscribers. They still have a lot of runway in front of them in terms of converting those subscribers, but their EBITDA tripled to 13 million. And that was over the course of about 3 years. So they took a look at, how do we take our existing business and kind of rejigger it into something that's going to be much more valuable. Another area to start to focus on is looking at your management team and your personnel. This is a tough one for founders to swallow, but make yourself dispensable. The company can't be about you. I mean, maybe it works for Elon Musk, Well, maybe it doesn't work for Elon Musk.
Yeah, maybe it doesn't. I think
You're right.
it worked
Actually,
for a while till we figured out
it
who he
worked for a
was.
while, and maybe the Twitter value is dissipating in real time. But you want to make yourself dispensable. You want to build a strong bench. If all the institutional knowledge is in your head, that's not monetizable. Especially, there's the fear that you get hit by a proverbial bus and, all the value's gone. So try to institutionalize that knowledge. And the best way to do that is to have a good, strong bench when key relationships are shared among the management team. And minimize nepotism. I'm actually looking at a company right now wants to raise some capital. CEO, woman founder, her CFO is her husband. And frankly, that's a negative. There have been too many horror stories that come out of those kinds of situations, especially if there's something really unfortunate along the lines of a divorce. It can really kill a company. Another area to look at is your financial reporting. You want your numbers to be, first off, small companies suffer this a lot. Have your numbers readily available. Have them be reliable, have them be accurate, but have them be readily available. I can't tell you how many times we are dealing with smaller companies and it's taking them a month to pull the numbers together. It doesn't instill confidence in a buyer or an investor. And to the extent you can get your financials audited, that's great. That's not necessarily realistic for a lot of smaller companies. Anything shorter than an audit, I would say you would want to get your numbers reviewed. A compilation is the least official. There's some value to it, but I would say at least get a review from an accounting firm if you don't want to pay for the audit. One thing that's quite common these days is a quality of earnings report. I won't get into it too detailed right now, but basically there are companies that when they put themselves up for sale will hire an accounting firm to put together a quality of earnings report, which is not quite an audit, but it looks at basically all aspects of the P&L and gives almost like a seal of approval that the numbers are legitimate and that they will also opine on the prospects for the company.
I'm curious if having like a fractional CFO is a way to instill confidence in buyers. So you're not investing the hundreds of thousands in a full-time true CFO, but you have someone who's got some credibility kind of supervising your finances.
I think that's a terrific advice. Those fractional CFOs have been through it. They come out of either accounting firms or they come out of big companies. It's a great way for smaller companies that can't afford a full-time CFO and really doesn't need one, frankly. But there are folks that are out there that will help companies get ready for a transaction. They've been through the drill. They know what information is needed. And it's a great way, Ken. You're right. Get them in maybe 4, 5, 6 months before you're ready to go to market and help you prepare your numbers. One of the things that they'll help you with is looking at non-recurring, non-operating expenses. So oftentimes companies will have expenses that a buyer will not incur going forward. And so what a banker will do is talk to the buyer and say, look, if you buy our client, you're going to have synergies. But not only that, whether it's cross-selling synergies or what have you, but not only that, all of these expenses are going to go away. These are one-time, maybe there was a lawsuit that got resolved. Or maybe, there was some sort of expense that was incurred in connection with, a conference or something that they decide they're not going to do again. Things like that. So basically you take the reported EBITDA number and you add back that expense that's not going to recur, and it makes for a better picture. The other thing you need to do is, if you're in the software business, you need to be looking at metrics that everybody wants to see. And you probably talk about this, I'm sure, with your clients: net retention, gross retention, LTV to CAC, logo retention, all of these non-financial metrics, but they're essential for displaying to potential buyers.
Yeah, it's really interesting. You talk about some of the KPIs. We've had some resistance from sales-oriented CEO founders to investing in customer success because their training and their skill set is on the acquisition side of new logos. And they may not really appreciate the dynamics of retention, negative churn, And yet the really savvy buyers, the ones that are going to pay the most, are going to want the highest quality business. And that business would be the one that has a great success component.
To me, that's crazy. I mean, your best prospects are your current customers, right? So why not upsell them? Otherwise, you've got a leaky bucket. And it's just too expensive to keep going out and having to, fill up the pipeline to offset the churn that you have. It's essential. And whether it requires a formal customer success effort or something similar, it's worth it. And retention is going to be key because that's the only way you're going to get the growth. Like I was talking about earlier, 200-300% growth. You're not going to get there if you've got logo churn or revenue churn well below, I should say, revenue retention well below 100%.
Yeah, one of the other things you sort of touched on, but I think it's important, especially in quickly growing companies, is the quality of the contracts, right? The consistency of your pricing. Can you talk a little bit about that? Like the consistency of contract utilization and pricing, things like that on the acquisition side?
Yeah, well, ideally you want multi-year contracts, and to the extent you can get paid up front, it's great for cash flow. You may not be able to recognize all that revenue up front, but from a cash flow perspective, it's great. You don't have to raise money. It's the best capital you can raise. But multi-year contracts are going to be key. And actually, that's a great segue to what my next point was going to be, was the legal review and looking at shoring up your legal profile. And one of the ways to do that is review all of your contracts with your customers and your vendors. Make sure you own the intellectual property. Okay. And it sounds like, really fundamental, but you'd be surprised how often there's a software audit that will come with a buyer. Well, they'll send a consultant in and they'll find that the IP that the selling company thought they had is not necessarily theirs, or there's a very high component of their software is open source. And so you want to really take a look at what's your IP and what are the customers that you have. Are they really under contract, or are you just operating with them on an ad hoc basis? And that can evaporate on a change of control. One thing that also does happen when you have a change of control is you want to avoid having contracts that the customer can bolt if there's a change of control. So to the extent your contracts can read that they can't do that, that will help in a transaction. Try to resolve any outstanding litigation. All companies have some legal issues. To the extent you can clean it up, do that. If not, it's okay. You can ring fence it, talk about it with the buyer, and figure out how you're going to deal with that open lawsuit, if you will. And try to clean up your ownership structure. If you've got hundreds of people that are on your cap table, you may get held hostage when you're trying to negotiate a sale. You don't want somebody putting a gun to your head because they want a couple extra dollars. I think the last thing I want to talk about in terms of maximizing value relates to things you can do that are maybe less quantitative but more qualitative, like basically picking your head up. Look outside your company, track industry investment trends, look at the public companies in your space, look at the M&A activity in your space, look at the private equity or VC activity, and just see what's happening. Be aware. It's fine to be running your company and have your head down day to day, but every now and then you do need to pick your head up. You also want to seek to fill the gap. You want to do an assessment of where and in what way your customers are lacking. Try to be the buy in an acquirer's buy or build decision. And get on the radar of potential buyers well in advance of a sale. Get to know the key players in your industry. Go to industry events, leverage contacts. Don't be afraid to talk to your competitors. They may end up making a bid for you. It's not unusual. So cultivating an early relationship with potential buyers it'll give you a higher probability of being acquired rather than coming to them cold. Listen, we're in the business of selling our clients. And oftentimes, when we go out to the market representing our clients, a number of these companies are quite aware of our client, and a number of them are learning about our client for the very first time. That second set tends to be either not as interested or provide lower bids. So it is important to make yourself known. And then understand the key metrics that drive acquisitions in your industry and use them in the management of your own company. So pay attention to the rationale that acquirers give when they make an acquisition. So you'll see oftentimes, especially with public companies, they'll announce a deal and they'll talk about the pro forma impact it'll have on their KPIs or on their financials. And there was a quote, we're buying this company XYZ because we think it's going to do A, B, and C. Oftentimes it's platitudes, but take a look at it. It's important. There's nuggets in there that, might catalyze some thinking in terms of how you're strategizing for your own company. So I was going to pause there, Ken. The only thing I was going to leave to talk about today was covering maybe some common mistakes that people make. But before I get there, I'll ask if you have any questions.
Yeah, I think it's really interesting, the idea that people pay less for firms they're learning about at the time. Really interesting justification for being more public, in your communication, right? Managing your PR with a long-term view, like industry relations as a PR component.
Absolutely. I can't tell you how many times you'll talk to a potential buyer and they go, how come I never heard of this company? Like, if they're so great, how come, they weren't in the trade press, or, like, what am I missing, right? So there's tremendous utility to being known.
So it hurts the gut feel of a deal, right? If I haven't heard much from a firm, if I'm learning about them for the first time, I'm having that exact thing in my head. How come I don't know about these guys? Can they really be all that good, right?
Exactly.
One of the things, you touched on financial housekeeping. I'm wondering which accounting system or ERP you're on has an impact on the friction or lack thereof in a deal. I mean, do you need to be on NetSuite to be acquired, or can you be on other software?
Great Plains is okay. NetSuite is expensive, right? Listen, you'd be surprised how many companies are still on QuickBooks.
Maybe I wouldn't be surprised. I have a fair number of clients on QuickBooks. It's crazy.
I know there are bankers that are maybe pejorative about QuickBooks. I don't have a huge problem with it. I think, if used properly, QuickBooks is pretty good, but there are buyers that would like to see maybe some more sophisticated type software. There's an up and coming one called Jirav, Jirav. It's an FP&A software that's good for tech companies. It's a bit more sophisticated than QuickBooks. Great Plains, I mentioned. So, there's a number of them that are out there. The ones that I think are probably best are ones that can also track the KPIs that we talked about for software companies.
Let's do your common mistakes to kind of wrap up the episode. I think that'd be a good place to land.
So don't oversell. Okay. Don't oversell. I know it may go contrary to your personality, but there's no reason to oversell, to overstate. You want to conjure a sense of honesty and reliability and credibility. And if you oversell, it'll be very obvious and it'll make the buyer wonder about, what else you're overselling. Don't be defensive. Every company has its warts. Every company has weaknesses. It's okay to acknowledge that and talk about how you're going to mitigate it and how you're managing it. But don't sit there and say, we have no faults, we have no problem, everything's perfect. And don't sit there and say, we have no competitors. You might not have anybody who's a direct competitor to you, but I guarantee you there is a substitute solution for what you provide. So, a little humility will go a long way. It may be counterintuitive as you're trying to sell yourself, but humility is valued. And then the last thing is unrealistic valuation expectations. And it kind of gets back to what we talked about earlier. The multiples for bigger companies, the ones that you read about, are not the multiples that you're going to get if you're a $10 million ARR business. So just be realistic with your expectations as it relates to valuations, and also acknowledge the current environment. We're not in 2021 anymore.
Fair enough. Marty, that was great. We covered a lot of material in a short amount of time. I really appreciate it. Thanks for your preparation. If people want to reach out to you to learn more and maybe sell their company, how can they find you?
Martin.Magida, Magida, at BerkeryNoyes.com. Berkery is BerkeryNoyes. Noyes.com.
Awesome. Well, thanks so much. If listeners want to reach me on LinkedIn, it's linkedin.in/Ken Lempit. And if you haven't subscribed to the podcast yet, please do so wherever podcasts are distributed. Hey, Marty, thanks very much. And by the way, you're on LinkedIn too, right? You're pretty active.
I am on LinkedIn. That's correct. Yes. I think there's only one Martin Magida on LinkedIn, as far as I know.
Great. So if folks want to reach Marty on LinkedIn, that's a great way too. Thanks again for sharing your expertise on SaaS backwards. And I'll look forward to speaking with you again soon, Marty.
I enjoyed it. Thank you, Ken.
Thanks for listening to the SaaS Backwards podcast, brought to you by Austin Lawrence Group. We're a growth marketing agency that helps SaaS firms reduce churn, accelerate sales, and generate demand. Learn more about us at www.austinlawrence.com. You can email Ken Lempit at kl@austinlawrence.com about any SaaS marketing or customer retention subject. We hope you'll subscribe, and thanks again for listening.